Let's talk about the whale of the Indian banking sector, HDFC Bank. If you've been holding this stock recently, it has likely been a major test of your patience. Over the past year, HDFC Bank has deeply underperformed the benchmark Nifty 50, posting a negative return of roughly minus 20% while the Nifty climbed higher. Looking back over a 5-year horizon, the pain for long-term investors is just as clear. The stock has underperformed both the Nifty 50 and the S&P 500 by a massive margin, moving practically sideways while global and domestic indices delivered strong double-digit gains. The primary triggers behind this multi-year underperformance boil down to the unresolved leadership structure, governance issue, plus the massive merger with HDFC Limited, which compressed the bank's net interest margins, led to persistent deposit mobilization pressures, and caused heavy institutional selling by foreign investors, reallocating capital away from heavyweight financials. But this underperformance has created a massive valuation anomaly that smart investors need to look at. Right now, HDFC Bank is trading at a trailing PE ratio of roughly 16.1 times and an even lower forward PE of around 14.3 times. To give you some context, this places the stock squarely at the absolute bottom end of its historical valuation range over the last decade. If we look at the historical perspective, HDFC Bank's 5-year average PE ratio stands at approximately 19.5 times, while its 10-year historical average PE sits even higher at nearly 23 times. This massive contraction means the current PE multiple is incredibly attractive, indicating that the stock's valuation has rarely been this compressed in its modern trading history. From a broader market perspective, this compression makes HDFC Bank significantly cheaper than the market average. While the broader Nifty 50 index is currently trading at a consolidated PE ratio of around 20.8 times, and S&P 500 is trading at PE ratio of 31.45 times, HDFC Bank sits comfortably below it at 16.1 times. It is incredibly rare for India's premier, highest quality private banking franchise to trade at a steep discount to the average stock in the market. So naturally, anybody would ask, is it the right time to invest in HDFC Bank? Let's investigate further. Looking ahead, the analyst consensus projects HDFC Bank's EPS to grow at a steady compound annual rate of approximately 11.5% to 12% over the next 3 to 5 years. While this is slightly more conservative than the bank's historical high-growth era, the projections are backed by strong fundamental logic highlighted in recent annual reports and management commentary. The core growth drivers are twofold: a major strategic push to expand retail and SME loan books, which offer higher yields, and a targeted branch expansion in semi-urban and rural areas to lock in granular, low-cost deposit mobilization. Analysts expect that as these massive new investments mature and the structural drag from the HDFC Limited merger normalizes, improving cost-to-income efficiencies and stabilized net interest margins will steadily fuel this double-digit earnings growth. When we factor that expected growth into the valuation using the price-to-earnings to growth, or PEG ratio, the opportunity becomes even more interesting. Right now, HDFC Bank is trading at a trailing PEG ratio of approximately 2.4 times. While a traditional textbook definition considers a PEG ratio above 1.0 times to be premium, you have to contextualize this for India's largest private bank. Historically, because of its absolute dominance and consistent execution, HDFC Bank has always commanded a significant growth premium from the market. At a PEG of 2.4 times, the stock is trading vastly lower than its recent 5-year peak PEG, which spiked past 10 times during the absolute worst of the merger-induced earnings slowdown in 2025. This sharp normalization indicates that the market is finally adjusting its expectations, pricing the stock at a much more reasonable equilibrium relative to its newly established double-digit growth trajectory. We see an identical, historically cheap setup when we look at the price-to-book, or PB ratio. Right now, HDFC Bank is trading at a current PB multiple of approximately 2.1 times. For a bank that consistently delivers an ROE of 13% to 14%, this asset valuation is incredibly compressed. To put this into perspective, the stock is currently trading nearly 23% cheaper than its recent 3-year average PB of 2.7 times, and significantly below its 5-year historical average PB of roughly 2.8 times. Historically, during its peak growth eras over the last decade, HDFC Bank comfortably commanded a premium PB ratio well above 3.5 times to 4.0 times. Watching India's premier private lender trade at just 2.1 times, its book value reinforces that the stock isn't just cheap on an earnings basis, it's trading at deep value relative to its net asset base. The natural question now comes is, what is the reason for this underperformance? Beyond the financial metrics, the market is punishing HDFC Bank due to a major governance discount and heavy institutional selling. Investor confidence took a severe hit following the unexpected, immediate resignation of the bank's non-executive chairman, Atanu Chakraborty, who openly cited ethical misalignment with certain internal practices over his final years. He said, "Certain happenings and practices within the bank that I have observed over the last 2 years are not in congruence with my personal values and ethics. This is the basis of my aforementioned decision. I confirm that there are no other material reasons for my resignation other than those stated above." Compounding this, a formal internal vigilance investigation into millions of rupees in misclassified marketing expenditures further triggered a trust deficit. For a premium banking franchise whose entire thesis is built on pristine corporate governance, these red flags cause foreign institutional investors who own a massive chunk of the bank to aggressively dump their stakes, wiping out billions in market value, combined with the ongoing operational strain of absorbing HDFC Limited's low-margin mortgage book and struggling to scale up low-cost retail deposits quickly enough. The market is aggressively repricing the stock, forcing it to trade at an extreme trust and liquidity discount until permanent leadership and regulatory clarity emerge. While corporate governance and margin compression have weighed heavily on the stock price, the bank's core asset quality remains a massive fortress. In fact, this is arguably the strongest pillar of the entire HDFC Bank thesis right now. According to the bank's latest audited financial data, the gross NPA ratio actually improved year on year, dropping down to a highly comfortable 1.15% from 1.33% in the previous year. If you strip away the volatile agricultural portfolio, the core ex-agri gross NPA falls to an even sharper 0.91%. On the net asset side, the net NPA ratio stands at a microscopic 0.38%, proving that despite the massive post-merger balance sheet expansion, the bank's strict underwriting guidelines have successfully prevented any systemic bad loan buildup. Provisions also declined significantly, down over 18% year-on-year to 2,610 crore rupees, indicating that credit costs are normalizing, leaving the bank structurally robust even while the market continues its aggressive pricing correction. To counteract these short-term headwinds and hit its aggressive long-term targets, HDFC Bank management is executing a deliberate, multi-pronged growth strategy. First, the bank has aggressively pivoted to a deposit-first model, focusing heavily on building a granular and highly sustainable liability franchise. This is evident as deposit growth has outpaced credit growth at 14.4%, with a massive 47% of all new deposit additions coming from stable retail accounts under 3 crores. Second, the bank is tapping into massive cross-selling opportunities by doubling its customer base to a staggering 100 million users, allowing them to systematically funnel existing clients into high-yield retail products like credit cards, auto loans, and mortgages from the merged HDFC Limited ecosystem. Finally, they are unleashing immense operational leverage by modernizing their tech stack with a $1 billion technology budget. By building a decoupled AI-ready intelligence layer and an enterprise-wide API gateway, the bank is driving its core cost-to-income ratio down from 40.5% to 39.5%, paving a highly efficient path toward normalized double-digit profitability. To truly appreciate the current valuation anomaly, you have to look at the legendary wealth creation machine HDFC Bank has been in the past. Over the last decade, this stock has been the absolute golden standard of consistency, delivering a phenomenal 10-year revenue CAGR of 19% and a rock-solid EPS CAGR of 20%. Even over the tighter 5-year window, it maintained an impressive profit growth of 19.1%. When it comes to rewarding shareholders, its dividend has steadily hummed along at a robust 24% over the last 10 years and 22.85% over the last 5 years, backed by a highly disciplined 31% payout ratio. And because banking is fundamentally about liquid financial strength, its free cash flow, FCF, has closely mirrored its core net profit growth, compounding reliably in the double digits for more than a generation. For a business with this kind of historical compounding pedigree, the massive price correction we see today is a historic deviation from its long-term financial trajectory. Now, a company can be the absolute best at what it does, but it's never worth to buy its stock if it's not available at a fair valuation. If we look at the company's valuation from a historical PE multiple standpoint, it is extremely undervalued. As we can see, the historical PE for the bank over the last 10 years is approximately 22.32, while it's currently trading at a PE of 16.15. So if we ever witness a multiple expansion or foreign investors return to the Indian market thinking the US market is extremely expensive, which I do think is the case, then we can easily see the stock touching 1,102 per share in Indian rupees. If we value the stock based on what its peers are trading at, we see Kotak is trading at a PE of 20.5, ICICI Bank at a PE of 18.34, and Axis Bank at 16.12. If we average the three, we get a value of around 18.33, which is also greater than the multiple HDFC currently commands from the market. This method shows HDFC can reach 905. Moving on, if we value the stock using sensitivity analysis, if we see consensus estimates for next 5-year EPS growth rate for HDFC Bank, we find that they vary from a range of 8% to 15%. And if we assume that HDFC reverts to its historical PE ratio over the medium term, we can see that the stock can easily reach 1,200 to 1,400 range, which is approximately 50 to 75% higher than its current share price. And I am of the opinion this can be achieved within the next 1 year. Now, it may or may not happen. This is strictly my view. This is not a recommendation. This is for education purposes in order to teach you how a stock should be valued. So all in all, do I think the US markets are overvalued? The short answer is yes. At 32 times earnings, it takes a lot of courage to buy US stocks right now. Plus, the Buffet indicator, which compares the total US stock market capitalization to GDP, shows a value of 230%. This ratio sits over 2 standard deviations above its historical trend line, suggesting the stock market is significantly outpacing real economic growth. So, I personally am diversifying away from the US markets right now to find hidden gems in international markets. And one such gem is HDFC Bank. And I do think sooner than later, investors and hedge funds will begin to rotate their holding abroad, which is directly going to benefit stocks like HDFC Bank. As we have already seen from our 3 valuation methods, the stock is significantly undervalued, and if we average our findings, we arrive at a fair value of 1,100 per share for HDFC Bank, which is approximately 38% above the current market price. Please do your own due diligence before taking an investment decision. Plus, if you found this content helpful and you did learn something, please subscribe for more content like this. Thank you.